let's walk through the what if scenario. We'll walk through this in the workshop itself. We want to actually just walk through it one more time here. Now, what if I brought in another expense in my company? Maybe that's hiring another individual. I bought a new truck. I took on a new expense. What's going to happen to the cash flow? What's going to happen to the profitability? And more important, what do I need to do to my hourly rate to make sure that I maintain the other two? So in my company up until now, I've been working under the scenario that I've got 2 service technicians, and those 2 techs are busy. We've got plenty of service work for them. Between that and maintenance work, they are running constantly. If I could bring in a 3rd technician, I think I could keep a 3rd tech busy as well. But again, I know that bringing in another technician is more than just an hourly rate. There's a lot of other expenses that go into bringing on this other individual. So let's look at that. And I want to take a look at what is it going to cost me to bring this individual in. Okay, so that's where we're going to start. Now, let's also look at our current company. Right, so when I look at our current company and our planning for profit software, one of the things, I'm going to first go to reports in the software itself, and we're going to go to the net profit analysis report, because in my company, we just want to outline real quickly, where are we at today? What's our starting point? And so if we look at it, in my service department, I'm currently set to an hourly rate of $140 an hour. Now, if I bring somebody else in, I don't want to change that rate at all. I'm already high in the market. So I want to leave myself at $140 an hour. And again, will this help me or will it hurt me? Well, as I scroll down and look at this individual report, I can see that at my current rate of $140 an hour, I'm doing approximately $541,000 in total revenue, and that represents $65,610 in net profit. Now, if I bring in another individual, I better make a whole lot more than $65,610, because there's going to be more work on our part inside the office to make sure that we keep this guy busy. All right? I don't want to just break even. I want to make a whole lot more. Because if I'm not going to make any more than that, well, then why bother? Right? I don't need the extra work to end up with the same amount of net profit. So that's our starting point. Right? We're going to leave it locked in at that point. So let's take a look at this a little bit farther. If I bring this individual in, of course, I've got to pay him a wage. Now, I want somebody that can start contributing immediately. Not somebody that I'm going to have to train for a couple of years. I want them to come in and basically be able to hit the ground running pretty quickly. So I'm going to set him at $25 an hour. That's the guy that I'm targeting. Now, I know at that rate, I'm also going, I've got an experienced tech at this point, so I'm going to give him out of the gate 2 weeks of vacation. That's 80 hours of time. That'll be non-billable. We're going to have the major 6 holidays. That's another 48 hours. We'll give him those as paid. And I also know that, again, a chunk of his time while he's on board is going to be lost. The average for a technician across the U.S. is 50% non-billable. My team follows right along with that. And so I'm going to assume that we can bill out only 20 hours a week. The other 20 hours a week will be lost. So that's the tech themselves. But now I need a truck, right? I don't have an extra one sitting around, so I'm going to have to go out and pick up a truck, right? So I'm figuring on this truck, it's going to be $35,000 is what it's going to cost me to get into this thing. And based on the way that my team typically drives their trucks, I can get 7 years out of the life of this vehicle. Right, so I've paid the guy. I now have a truck, right? And he's going to go out and do some work. Now, I also know that he's going to be using materials along the way. And so what I'm going to look at here is the national average for a service technician is $25,000 material cost per year. And again, we can have markups all over the map. For purposes of this discussion, we'll use a 100% markup. So this technician will sell another $25,000 worth of material cost at 100% markup. Now, that's the tech, that's the truck, it's the materials we've got accounted for, right? But there's a lot of other overhead expenses that will go into this mix. So when we start looking at this, the other overhead, as I just sit down and think about it, we all wear uniforms, and if we start looking at uniforms, that's going to cost me $500 a year for that. There's, again, a number of different insurances. So in our case, we give an allowance for $5,000 a year toward health insurance. Our workman's comp is going to go up about $2,500 per year to bring this guy in. There's going to be an increase in liability of about $2,500. We got to put insurance on that truck. That's another $3,000. So right there's a whole number of expenses that we just picked up. We always do quite a bit of training with our team. Now, again, it's $25 an hour. He's an experienced guy, but technology is always changing so fast. And so we will do some training with him. I'm going to put another $2,000 a year in here for that. We're going to have communications. It's a cell phone. We're going to have a tablet. We're going to have, whatever those devices are that we use within the company. In my case, I'm assuming that that's going to cost me another $2,400 per year. Now, he's driving this truck. We need to put fuel in the truck. That's going to cost me another $6,000 is what it's going to cost me to fill that thing up. We're going to have, again, that chunk there. We also got maintenance on the truck, oil changes, filters, tires, things like that. That's another $1,500. We're going to have tools that I need to put in the truck. Now, again, he may provide his small tools, but kind of the major things I need to provide those. And this is the first year we want to see, does this make sense for us in this first year? So I'm putting $2,500 in there for some of the major tools he'll need on his truck itself. We accept credit cards as a company, so part of what, he may be doing work and bringing in some revenue, but every time a customer wants to pay with a credit card, we end up paying for that fee. So that's going to cost us another roughly $4,500 a year is what I'm figuring. When I bought that truck, I didn't plan ahead for that, so I had to take a loan out for the truck. So I'm going to have to pay, $600 a month or so somewhere around $7,000 a year in my full loan payment. Right, and then I know I probably missed something, so I just threw another $2,500 in there for miscellaneous stuff. I tally all that overhead cost up. That's another $41,900 in additional overhead. So if we start looking at that, just kind of grouping it, at $25 an hour, our tech is going to make about $50,000 a year. Right now, again, of that, we're going to give him paid holidays. We're going to give him 2 weeks of vacation, and I know that I can only bill out 2 weeks of his time. Bill out 50% of his time, right? The rest is all going to be lost. 20 hours a week will be lost. We're going to pay about $35,000 for a truck. And then in addition to that, we're going to take on another $41,900 in overhead expenses. So I just want to make a quick note of these. So $25 an hour, we said we got the $35,000 truck at 7 years. And we've got $41,900 in overhead expenses. So let's go ahead and enter this in. We'll walk through that what-if scenario and see, does it make sense for us? Because remember, two guys, we're making $65,000 in net profit. We're going to take on all these expenses. Are we going to make more money or are we going to make less? That's the question. So I'm going to flip back over to the software real quick. Now, the first thing I want to do is I'm going to go into setup, because we spent a lot of time creating this model. I don't want to mess this one up at all. And so what I can do is I can go into company models right here, and I can make a copy of my particular model, right? So there's my standard business model right here for Mr. Magoo's Heating and Cooling. We've got the last couple of years we've been working with the software tool itself, so I see each one of those years that are out there. To make a copy of this model, all I need to do is hit the action icon, the three little dots right here, next to standard business model, the particular model I want to make a copy of. And when I do that, I'll click on that, and it gives me the option then to copy that company. That's what I want to do. I want to make a copy of it. So I'm going to do that, and it's going to pop open with this window. And you can see right here, it's got standard business model. That's the original. And now what's the name of this new model that we're making? Right? It's just a copy inside your company itself. Now, I always recommend use a name that means something to you. Don't say copy 1 or copy 2 or copy 3, because when you come back here 2 weeks from now, you're not going to remember what you did in each of those copies. Give it a name that means something to you so that when you see the name, you know exactly what you did with that particular model. So in our particular case here, I'm going to call this one Third Tech. Right? So again, we're adding a third tech to our particular model itself. Now I know that's what we're doing there. So at that point, I'll just simply click on OK. The tool is going to make a complete duplicate copy of everything you've got in your standard business model. Right? So it tells me we have success, and I can see at that point in time that I now have, here's my normal standard business model that we had before, and now here's our new copy, the third tech. And again, every year, copies right along with it. It's an exact duplicate of what we had before. Now, if you remember, right up here, it's always telling us what model, what copy we're looking at. Right now, we're looking at the standard business model for 2021. In the active column, you just simply set the green dot in whatever copy you want to be working on. So I want to be working on my add third tech down here in 2021. And when I do that, again, any changes that I make here will not impact the original at all. As soon as I make that change, you notice right up here, I've now switched over to third tech for 2021. That's the model that everything that we enter in here will start to impact. Now at this point, I can simply just go back to setup, and we're going to, in setup, we're going to go into costs input, right? So in costs input, you remember these screens, this is where you entered all of your data. All we need to do is literally walk right down this line and enter each of these items in down the way. So we'll start out with the equipment. Add a new truck. If you remember, we hit the add equipment icon here in the upper right-hand corner. And so I'm going to add that truck. And all I need to do here, again, I can simply just call each one third tech, because that way when I look at my reports, I can, or these lists, I can very quickly see, here's the entry that I made. Right, so we're just going to call everyone third tech. I'm going to say this is existing because if I buy it, bring the guy in right now, the truck is existing. Year to start, 2021. That's where we're doing it. Now, we said I can get 7 years out of this truck, and we were going to pay $35,000. All right, so we plug that in there. Again, we leave it included in our allocation percentages because it's a fuel burning piece of equipment. And since this is a service tech, this truck is going to spend all of its time in the service department. We're going to allocate all of these expenses 100% to service itself. So once I put that in, I can now accept it. It's going to add that truck to my list. All right, we see that new truck up here, third tech for $35,000. We're going to start building that $5,000 per year into our pricing to make sure that when this truck dies, that we can go ahead and write out a check and pay for the new truck at that point. Next one down the line, we'll go to labor. As we go to labor, again, we're simply going to click on add labor. We're going to enter in, I'm going to call it again, third tech. All right, we come down, this employee has direct labor hours. He's hourly. We said his rate was $25 per hour. We need to go into input hours. And on this screen, I can see that, number one, we said his lost time was 50%. Right? His total hours are 2,080 hours working throughout the course of the year. So we've got 1,040 lost hours. We said that we were going to give him, when I look at this, we were going to give him vacation hours of 80 and the major holidays. So we'll start out there, and I'm going to go down, and right at the bottom, I just want to make sure that this is going to work from a financial standpoint. So we said he had 80 hours. I'll plug that one in there. It'll spread it throughout the course of the year, and we're going to give him the major holidays. So that's 8 hours in January for the first of the year. We've got Memorial Day. We've got Labor Day. 4th of July. All right, we'll go down. Then we've got Labor Day, another 8 hours, and then we've got Thanksgiving, and we've got Christmas. So there's our 48 hours. I can now go ahead and click on accept in the bottom right corner and accept all of his parameters there. So I can see at this point in our rough numbers, I said he was going to be at $50,000. It's actually $52,000 that we end up with here. As I scroll down, by the time we paid him his vacation time and his paid holidays, he's at about 56% non-billable, 44% billable is where he shakes out. And then again, he is going to be working in the service department, so I need to allocate him 100% to the service department. I'll go ahead and click on accept when I've got that entered, and this third tech will now be added to my list of employees as well. All right, so his wages now factor into my total wages on the company. Next is going to be overhead expenses. Now, we've got both fixed and variable overhead. I'm not really looking to project cash flow. I just want to see, does this make sense for me from a profitability standpoint? And so we could go through and actually break down the fixed overhead and the variable overhead individually. If you remember, we just lumped them all together. It was $41,900 in total overhead costs. I'm just going to simply enter them in as one entry under fixed. So I'll come here and say add a new fixed expense. I'll call this one third tech. Okay, the expense hits monthly. Okay, we can certainly do that. Actually, for purposes of this, I'm just going to say annually, and I'll put in one chunk, 41,900. Right? Again, I'm not really trying to project cash flow. If I was trying to project cash flow, then I would actually put it in monthly and where does it hit? I just want to add the expense into the company itself. As I scroll down here, I want to select my category. Again, it's just total expenses, so we can really, for this purpose, put it under anything that we need to there. All right, we could actually leave that one blank for this purpose. And allocation method, again, we're going to allocate it 100% to service. I can accept that overhead expense. All right, so we just put the entire third tech overhead expense of $41,900. We built that into the company itself. Next in line is going to be materials. We said that this guy was going to sell some materials. We got to pay for the parts, but then we are going to recognize a little bit of revenue coming in off of those. So I'll go into materials themselves. I want to add, and I could just edit the materials that are there, but it's easiest when you're doing this to just add a new entry. And so I'm going to call this again, third tech. All right. Method to apply. I always use direct labor hours here. We said the tech was going to use $25,000 and he was going to be at a 100% markup. All right, so we're going to sell that for $50,000. And I get down to the bottom portion. We're going to allocate all of that expense and the revenue to the service department, and we'll accept that one. So if you look at just that piece right there, we just entered in, think about it, we entered in every one of the expenses that we had accounted for. We've got the tech's wages, we put in his truck, we put in all the overhead expenses, we accounted for the materials that he's going to bring in, right? So right there, that quickly, we just accounted for all of those expenses. So at this point, we can see, does it make sense for us? Now, if you remember earlier, right, we had done with two technicians, we did about $541,000. We had $65,610 in net profit. Now, we just took on all these expenses, and the question is, does it make sense for us? So now let's go back to our reports, and let's take a look at that net profit analysis report one more time. Net profit analysis will come down to here. Again, service department is still locked in at $140 per hour. I don't want to change that. All right, I'm already a little bit high, I think, in the market. So with that, let's scroll down and take a look at what happens to our profitability. As I get in there at $140 an hour, I can see that I'm now going to do $718,663 in total revenue for a profit of $113,932. Now keep in mind, compare that with two techs. Before, we were at $65,610, taking on this extra expense and bringing in this tech, that went up from $65,000 up to $113,000, almost $114,000. Now, if we look at it, if you remember, and I don't know if you recall, but before, my break-even rate was somewhere around $113 an hour. Look at it now, it's $106.75. How is it that we can take on all this extra expense and have my break-even rate go down? Again, remember, it's all about the billable hours. There's two factors in here, but the biggest factor, right? So he did pick up another $25,000 in material profit. That's going to offset overhead. But the huge advantage is billable hours. We went from about 2,300 billable hours up to 3,400, right? We added another 1,000 billable hours to our mix. And it's not just the expense of this one technician that is spread across all those hours. It's all of my overhead for the service department, which is spread across those extra 1,000 hours. And as a result, the amount per hour goes down. Makes sense. Now, this will always be the case as long as one other thing holds true. Now, again, remember, one of the assumptions we made is that I have enough work to keep this guy busy. But again, this will always hold true as long as one other item is true as well. And that's that you don't have to hire somebody else inside to manage the new guys outside. right? Because if all of a sudden I've got to hire somebody else inside, well, that's going to start to eat away at this net profit here. And so that starts to create a little bit of an issue. Now, let's go take this one step farther, right? What if I'm wrong? I said I think I can keep this guy busy, right? And we're billing out 50% of his time and our profit went up in a bit. What if I'm wrong though? What if I can't keep him busy? What's my worst case scenario, right? So I can simply go back and walk through that one more time, right? And let's make a quick shift here. I'm going to go back up to setup and we're going to go into cost input. Right on the menu, and the only thing I'm going to change, right? Because once we've made this decision to move forward, we've taken on all those expenses. But what if I can't keep him busy? Let's go in and modify this third tech. All right, so I'm going to click on the three dots, hit edit, and I'm going to go into input hours. And let's say I can't keep him billing out 20 hours a week. In fact, I can only bill him out about 25% of the time, roughly 10 hours a week. 75% not billable, right? So if I kick this up to about 1,500 lost hours, right? If we look at that, now when we do the math on it, I'm only billing out of this guy working 2,080 hours a year, I can now only bill out 452 hours. Right. Now, again, so what if I'm wrong? How does that hurt me? Right, so let's go ahead and accept this change. Right, we'll accept it here at this level again, right? So we just brought this, added that extra expense in here because now most of his time is non-billable. We'll go back to reports and the net profit analysis report. And I can see at this point, staying at $140 per hour, I can see looking at it at 140, I would now do about $654,000 in total revenue and my net profit, $49,701. Lower than I was with two guys because I took on the extra expense. But here's the upside. It didn't kill me. I'm still profitable. And now I've got a whole lot more bandwidth in my company. So now I can really start focusing on marketing that service side of my business and really start ramping things up. Know the numbers. Run the what if scenarios. I can do this with anything. I want to buy a new truck, right? I want to take a vacation. Heck, I've got one contractor I worked with that had a special charity that he wanted to develop, right, and fund it out of the company. So he added in a line item into the expense of the company, right, the overhead expense, where he was building in another $100,000 into the expense of his company to support this other charity. What did he have to charge per hour to make that happen? Right. So again, I can walk through this scenario. Even in this case here, I could go back up and say, I want to modify my calculation method and say, okay, give me a 10% net profit. It would then tell me, what do I need to charge per hour to hit that 10% net profit? Use the what if scenario on a regular basis. Remember that when you're in your setup and your company models, you can create as many different copies as you want. I can take and create a copy of this third tech copy if I wanted to, and start to play that what if scenario as much as you would like. If you have any questions with regard to this, feel free to reach out to us at Grandy & Associates.